if you rely heavily on a few investments to carry your portfolio, if you put all your money in Apple or Netflix and think that that's a diversified portfolio, it's really not. So you want to make sure that you're properly diversified and following a strategy that's going to give you the highest probability for success.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. Hope that you are off to a good start in 2021. I thought it'd be a good time of year to go over some common investment mistakes and how to avoid them. So I put together a list of some of the ones that I've seen over the years. And number one that I've seen is that having expectations that aren't aligned with reality, meaning that a lot of us will look at past performance of investments. It might be how you make investment decisions about what portfolio is appropriate for you or even particular investments that you're going to purchase. But a lot of times the past performance does not match up with future performance. You probably see in investment disclosures, and rightfully so, that past performance is no indicator of future returns because the past doesn't repeat itself exactly. And if you're buying an investment expecting that the investment averaged a 7% return in the past, that it's going to average a 7% investment in the future, then that's probably not going to happen. So you want to have the right expectations because you don't have control of when the stock market will go up or when the good returns will happen. So you just need to be patient. And as long as you're putting together the right type of portfolio, then your investments should be performing the way that you are hoping that they will. Number two is not having clear investment goals. A lot of times people will make investments just based off buying an investment that they heard about on TV, a friend told them about, they read about in Money Magazine, and that's not probably the best way to invest. That's really more speculation trading. If you're talking about your investment goals, it could be a short-term investment that you're making maybe to buy a second home, fund a large purchase, pay for a wedding, college education. If it's a shorter-term investment, then you're going to want to have a shorter-term strategy as far as maybe being more conservative. But for longer-term investments, such as your retirement savings, you want to have a longer-term focus. And for those investments, you probably want to be more aggressive. So you want to make sure that your portfolio matches up with the investment goals that you have. Number three is failing to diversify enough. I'm an advocate of using index funds for the majority of your portfolio and not buying individual stocks and bonds. I think it becomes rather difficult for most individuals to do that. It's okay to own a few stocks here and there, maybe as for fun, but for the majority of your money, I believe you should have a portfolio of index funds or actively managed mutual funds. And that being said, if you rely heavily on a few investments to carry your portfolio, if you put all your money in Apple or Netflix and think that that's a diversified portfolio, it's really not. So you want to make sure that you're properly diversified and following a strategy that's going to give you the highest probability for success. Number four would be focusing on the wrong kind of performance. And we talked earlier about, having the right expectations as far as your goals, but you also want to make sure you're focusing on the right kind of performance. I mentioned earlier the expectation that maybe an investment has an average return of 7%. When you look underneath the hood, let's say, of an investment that had an average return of 7%, you're going to see that very rarely, if ever, does the investment have a year where it makes 7%. You're going to have some years in there where it maybe goes up 20%, down 15%, maybe doesn't make anything. So you need to have the right focus on knowing that it's going to be an investment that over time, owning it a long time, 5-10 years or longer, that you're going to see those averages come about. In the short term, those averages might be far, far away from what the average return has been. Number five is buying high and selling low, right? That sounds pretty obvious. Why would you ever buy something and then sell it low? But people do this all the time. You might buy into an investment after a friend told you about it, or as I said earlier, you read about it in a magazine, saw it on TV, and all of a sudden you look maybe a couple months later and you see that investment is down and you sell it and get out of it. And that's definitely the wrong way to invest. The right way would be to have a long-term focus, to do some research on the investment, and if it's still appropriate, to really buy it and just forget about it. The best investments that I've ever made have been investments that I purchased and I didn't touch for a long period of time. Everyone can be guilty of this. When you're checking your account all the time, then you have a higher probability of making a bad decision. And that leads us to our next mistake, tip number 6, trading too much and too often. Thanks to technology, it's a lot easier than it used to be to trade your investment account. Thanks to apps like Robinhood, you can go on your phone and you can buy or sell a stock, a mutual fund, an ETF instantaneously. You can do it through an app. You can do it through your laptop. And this is good, but it's also bad. More trading and more trading frequency doesn't lead to better returns. Many studies have shown that the more you trade, generally the worse you do, because not only do trading costs start to add up, but also potentially getting out of the market at the wrong time where things going up can really not be good for your portfolio. You also don't know when a stock that you've purchased might end up turning around and doing well. So a lot of times investors regret ever selling an investment. So being more of a buy and hold investor can work in your favor. Mistake number 8 is be aware of low liquidity. What do I mean by that? Well, most of the investments that I recommend for clients are very liquid investments, meaning if you need to sell the investment, you can easily not only sell the investment, such as a exchange traded fund or a mutual fund, but you can get a very fair price for that investment. There are other investments that are not liquid, such as real estate, such as some private equity funds, certain low price stocks that don't have a lot of trade volume. Also, there are something called structured products, which banks and brokerage firms can issue. And a lot of these investments promise a lot, but a lot of times they end up not doing as well as their initial expectations. And part of that is the low liquidity that these have, meaning that unlike publicly traded ETFs, stocks, or mutual funds, where you can easily get a price as far as what it's worth, and there's also people that are standing by willing to buy that investment from you when you're looking to sell it. With these privately traded investments and low price stocks, there's usually very little buyers, and you might not be able to easily get a price for it as well, which when there's not a lot of people willing to bid on something also means usually that the price that you get is a lot lower than you normally otherwise would. So I'm not a fan of these investments. Maybe you can use a very small amount of your portfolio in these, but I think you'd be better off just avoiding them altogether. Number 9 would be reacting to the media. Thanks to 24-hour cable news, there's more information out there than ever about what to do with your finances, how to invest your money, and these shows are not designed to help give you investment advice. I don't think any of these shows make the claim that they're a fiduciary doing what's best for you, which is what my goal is for my clients. Their goal is to keep you watching, to sell you advertisements, to sell you products, to get you to put all your money in gold, as some of these commercials advocate. So just be aware that this is entertainment and don't follow the advice that a lot of these people are giving. Some of them, a very small percentage, do give good advice, but for the most part, they make a recommendation and they're never held to account for how that recommendation did. If they recommend a stock, they don't show a chart showing all this guest past recommendations and how they performed, or if they're coming on telling you to get out of the market, to sell all your investments, which they frequently do, they don't ever come back and see, well, if you hadn't followed their advice, how would you have done? Or if you had followed their advice, how would you do? So really just recognize that it's entertainment and don't rely on that for your investment process or investment decisions that you're making. Number 10 is chasing yield. What I mean by that is from time to time, there are stocks out there that have very high dividend yields. And how does this happen? Well, it happens because the company is mismanaged and the share price goes down significantly. And now all of a sudden that company that maybe had a 3 or 4% dividend has an 8 or a 9% dividend. So that looks attractive, but if you don't do some research to figure out what the company's future earnings look like, what the stock price has done, then you're not understanding that most likely a lot of times when you're buying a company like that, or the price is probably going to go down further, or the dividend could be cut because dividends aren't guaranteed. Dividends can be changed anytime by the companies that issue them. And as soon as that happens, you see the stock price go down even further. So dividends are definitely an important part of your total return, but I wouldn't solely focus on dividends as you're building out your portfolio. I think you're better off looking at total return and buying index funds or high quality companies that have reasonable dividends where the expectation is that the company or the fund's earnings are going to continue to go up and not go down. Number 11 would be trying to time the market. And we talked a little bit about this earlier, but that would mean trying to make predictions as far as where the stock market or the bond market is going to go. Trying to predict that where we currently are, is the stock market going to go up? Is it going to go down? Most people would agree, most professional investors, that that's really a fool's errand, that it's impossible to predict with any certainty where the market is going. You might get lucky once or twice, but over the long term, it's probably going to be extremely detrimental to your long-term success, more than it will help you. It might feel good because you're making a decision. A lot of times when things get bad, we feel like we have to make a decision, such as a large decline in your portfolio, but you need to really be focused on the process that you're using and the asset allocation that you have and the long-term philosophy, because different measurements can show how this is detrimental. JP Morgan looked at the S&P 500 from early 2000 to the end of 2019, and the return of the S&P 500 during that time averaged 6%. But they then went back and looked to see if you had just missed the 10 best days of those 19 years, just 10, your return went from 6.06% down to 2.44%. And that's very possible when you try to time the market, because many of the times the best days occur after the worst days. And we saw that in March. We had some very, very bad days through the middle of March, and then all of a sudden the market went straight up. And if you were trying to time that, you probably missed out on a lot of that performance. Number 12 is not doing your due diligence. Anytime you're making an investment, you should be doing some research on your own. You shouldn't just be relying on someone else's advice. You should be researching the company, looking at what the company does if you're going to buy individual companies, looking at the earnings history of the company. And if you're going to use someone to help you, an advisor, well, you need to be researching that advisor. There's many databases where you can research your advisor. You can go to brokercheck.com if they're a broker. I advocate not working with brokers. I think you should work with registered investment advisors only. In that case, you could go to the IAPD website, and you should be researching this individual or company. You should be talking to other clients of theirs and making sure you're doing everything possible to understand how they're helping you, making sure you're not getting involved, right, with the next Madoff scandal. So I had a previous episode, ways to avoid being ripped off by your advisor. I highly recommend that you listen to this episode if you haven't, so that you can avoid many of these bad things that have happened to other investors. And there's very simple ways that you can do that. Number 13 would be working with the wrong type of advisor. And I also mentioned in that previous episode that there are two types of quote unquote advisors. One is really not an advisor, and that's a broker. And that's either a stockbroker or insurance broker. And there's nothing wrong with these individuals. There's a lot of great individuals that work as brokers, but their obligation is to the company that they work for. They're not actually held to fiduciary standard, meaning that they don't have to do what's in your best interest. They're doing what's in the company's best interest, which is trying to sell you a product that the company makes money on, and they have the requirement to give you a reasonable recommendation, not a fiduciary recommendation. Whereas when you work with someone who's a fiduciary, either a fee-only advisor or someone who's working with you as a registered investment advisor, they have to work with you as a fiduciary, meaning they have to work in your best interest, disclose any potential conflicts, and really be an advocate for you and be a partner, not really be at odds with you and trying to sell you something all the time. I advise trying to go work with a fee-only advisor, but if you're going to work with a broker, it's really just best to understand where their conflicts are and research their past to see if they've had any incidents reported or any complaints, so that you can try to stay clear of those people that have a bad record. And number 14 would be letting emotions get in the way of your investing. And we're all, human beings. We all have emotions and feelings, and it's normal for any of us to get nervous, to get anxious if we start to see our investments go down, especially if we're looking at your retirement savings. You've worked hard for this money, you've sacrificed, you've saved, but you really need to have a long-term focus. And if you're focused on the short-term performance, you're going to drive yourself crazy. So understanding what some of your past behaviors are and making sure that your portfolio aligns to a portfolio that you have a strong likelihood of sticking with, not only in good times, but in bad, is going to give you a much higher chance of succeeding in your goals and making sure that you stick it out, I should say. As I mentioned earlier, how detrimental it can be to get out of the market at the wrong time. And the longer that you invest and stay in the markets, the better that you're going to do. Now that you know about these 14 investment mistakes that I've seen over the years, I hope that you're able to avoid many of them as you continue to invest in 2021 and beyond. If you're enjoying these podcasts and you haven't subscribed, please do so at Apple Podcasts or Pandora or whatever your favorite podcast app is. If you haven't left a review, I would greatly appreciate a 5-star review on whatever is your favorite podcast app. And I thank you for tuning in this week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.